everybody sits and does nothing for a couple of months. And so the sales drop. And then if they continue to stay stabilized, people come back to the market and start buying again. And then if they jump up, which what we've been seeing happen the last couple of years, they jump up again, they all paralyze, they freeze, and then they come back. If they drop again, they come back in. And so we're seeing it's very cyclical, up and down on the single family.
This is Dana Samuelson with the American Gold Exchange. You're listening to the Average Joe Finances Podcast with Mike Cavagioni.
Welcome back, everybody. So Tanya and I are going to chat a little bit about awesome guest that we just interviewed, Dale Wills. What an awesome conversation. Tanya, what do you think?
Yeah, I just thought it was great that he was just explaining the real estate market a little bit better and what he's been seeing over the last almost 20 years now of working on all kinds of different real estate and land developments. But what I really liked most is just like his authenticity and his energy, right? Like,
yeah, he was very genuine. Very genuine.
Yeah.
So
Yeah.
I feel like a lot of the answers to the questions that we asked, I mean, just so much value, right? For the people that are going to be listening to this episode, I mean, if you want to learn a little bit about like what's going on in the real estate market today and what kind of strategies you should think about to invest in today's real estate market, this is an episode you definitely want to check out.
Yeah, he does some really interesting things in real estate, and there's some good opportunities too. He talks about opportunities that our listeners or other people can look at too. So I think people are going to get a lot out of it. And just his mindset and how he thinks about growth, I think is really good too.
Yeah, he does have a very good growth mindset. With that being said, everybody, I really hope that you tune in today's episode and enjoy it. You guys are going to love this one. If you're watching this on YouTube, make sure you smash the like and subscribe buttons. If you're listening to our podcast, go leave us a 5-star review. All of our links can be found in the video description or show notes below. Hey, everybody, welcome back to the Average Joe Finances Podcast. I'm your host, Mike Cavagioni.
And I'm your co-host, Tanya Schultz.
And today's guest is Dale Wills. Dale, super excited to have you on the show. Welcome. And for those that are tuning in right now, this is take 15 of this intro. I'm just kidding. But anyway, Dale, thank you so much for joining us today.
It's good to be here. Thanks for having me. Appreciate you both.
Absolutely. Hey, we'd like to kick this off the same way we start every podcast episode, and we'd like to know a little bit more about you. So if you could tell us a little bit about yourself, share your story. Who is Dale Wills?
Yeah, I grew up at the base of the Sierras in California, and I was the 7th of 10 kids. My parents were incredibly loving and encouraging. They were always encouraging me to try new things and that they believed in me. However, we grew up really poor. One time I remember our vacuum cleaner broke. We couldn't afford to fix it. So we swept our carpets is what we did.
Wow.
And I was always doing entrepreneur something. And my parents were constantly encouraging it and telling me, you can do anything you want. I took that to heart. I hated school and I got expelled from school at a junior in high school, and I have not been back since. And I do not advise that route to anybody. There's much better ways. But it's interesting. At one point, really, the idea of continuing to learn was really instilled. And now I'm just a sponge for information. I read 50 to 60 books a year, listen to lots of podcasts like yours that you have really some amazing guests that you can learn from and just different opportunities. Fast forward, I've worked in banking, land development. I spent a season having some retail stores that were a lot of fun, learned a lot from home building, land development. So all over the board. 2008, when the market fell apart, we started Centra Company shortly after that. And we took advantage of the fact that the banks had most of the good assets because they had foreclosed on so many people. And so we partnered up with a lot of banks, 2011, 12, 13, doing a lot of things with them. And from there, once the banks ran out of assets for us to do anything with, we ended up then focusing predominantly on land development and home building. And since then, we're doing a little bit with apartments, small commercial, various things. And then just this year, we launched a real estate equity fund for people to invest in, which has an interesting background and story how we launched that. So that's a little bit of the background.
Wow. So it looks like you've really got into real estate and went that route. And what kind of made you go in that direction? Was there something specific? Like you said, you guys took advantage of what was going on in the market, but was there something else that was inspiring you to do that?
Yeah. So I had, your older audience would remember the Radio Shacks. It doesn't exist
Yeah.
anymore, but we owned 3 Radio Shacks, one of which in 1999 was the biggest Radio Shack franchise in the world.
Wow.
And Radio Shacks at that time, they would sell remote control cars. We were doing a lot with cell phones, satellite dishes, batteries. And today, most of what people buy at a Radio Shack, they just get off of the internet. And it really wasn't very satisfying. It was fun to grow something. It was fun to make it big. That was a thrill. But it's really, as we know today, if Radio Shack doesn't exist, it really doesn't matter. It doesn't change anything in life. And I had been in real estate and banking before that. And I went back because I just loved to make things better than I found it. Funny thing is, I own a home building company, but I've never lived in a new house. I love to make things better than we found them. And so the house I live in right now was built in 1937, and we totally gutted it and remodeled it. And the house we had prior to that, we did the same thing. So that's one of the things I love about real estate is you can really make a difference.
Yeah, absolutely. Talking about a house built in 37, gutting it's one thing. You like had to gut it down to the studs, replace all the plumbing, electricity, everything.
But it's interesting. When we walk through the house, I'm walking
Yeah.
through with my wife saying we should buy this. And my wife and my kids are just like, Dad, are you crazy? There's no way we could live in this. And I tell my wife, I said, we could take this wall out. And I go to knock on the wall. It's between the kitchen and the dining room. We could take it out and open up. And I discover it's solid. And so I look into it. The house previous, the owner had his house burned down. And he said, I will never have a house burned down again. So he rebuilt the house in 1937. Every wall in the house is brick. All the interior walls are double brick. The roof was steel and concrete. The only wood in the house were the cabinets and the doors. Everything else. So remodeling it was a bit of a chore because you didn't have places to run new electrical and plumbing, but it was a lot of fun.
Yeah.
It turned out
You
good.
didn't have to worry about the big bad wolf.
Yeah, no, our tornado comes through Minnesota and we're going to be just fine.
Wow. Okay. That's interesting. So do you think, did you bought that house after you had already established Centra, right?
Yeah, the house we're in now, it was actually, we get alerts when real estate comes on the market.
Sure.
So we can look at it and say, okay, does this make sense? And then certain types of real estate. And then if they change the price, we can look at it again. And about 6 years ago, a large piece of property came on the market that, oh yeah, we're interested in buying it. Looked at it real quick. Price is way too high. They lowered the price, looked at it again. Price is way too high. They lowered the price. Price is a little high. So I went and looked at it and I called my wife and I said, you know how I've always dreamed since I was a kid that I want to have my own little cattle ranch? She's like, yeah. I said, I think I found it. What do you think? So we bought it 5 years ago. We modeled the house and now I have my own little cattle ranch.
Oh, and that's separate from where you're at right now.
No, this is where I live. Actually, if you look at
so
the
the one that
pictures
you're currently
above
in.
me, these are the cattle on the farm that I live that they're out the window from where I'm sitting right now.
Oh, those are like your actual, that's really cool. Yeah, I was going to ask you about your cowboy hats and like your.
Yeah,
Well,
those
yeah,
are calves that were
thousands of
born
pictures in
last
the back.
fall.
Oh, wow. That's
That is
amazing.
super cool.
That's
Yeah.
great.
Okay.
So
I just got one more thing
literally, I
want to
drive
ask
down a
about
driveway
that.
and I say, I'm living the dream.
Yeah, that's awesome.
Yeah.
I just got one more thing I want to ask about that. So when you were looking for this property, right, and you kept saying, okay, the price is too high, and then it came down a little bit, it's too high, came down a little bit, and then it hit that negotiation zone for you, right? It makes me think about today's market. Makes me think about what's going on in 2024 with the high interest rates and the high real estate property prices. I mean, I'd like to get your thoughts on how somebody can invest in real estate in the 2024 market.
Yeah. The great thing about real estate, no matter how you look at it, it's the ultimate hedge on inflation. And for the last 3 years, we're averaging in the United States 5.21% inflation. And so it can be tough for people. How do you get ahead with that kind of inflation when people are getting returns on, you're losing money if you put your money in a savings account because you're not getting 5.21%. So you're getting behind. And the challenge is because of the inflation, real estate prices are driving so fast. And so it's tough to get in. And at some point we could talk about it. We created the real estate investment fund for this very reason, because I was looking at our employees that wanted to be involved and how do you get into it? The everyday person, you've had guests that have talked about this before, that the best way, if you want to get into real estate, especially if you're young, is to go get a HUD loan and go buy a house, a duplex, a fourplex. And that's where you start out. You can get a HUD loan at 3.5%. A lot of people are sitting on the sidelines right now in real estate. And one thing that people should think about, do I get in or do I get out? Let's wait until interest rates go down. Let's wait until prices stabilize. If you look back in the late 60s, interest rates were fairly low. Early 70s, they jump up. And so if you say, okay, let's look at 1971, when interest rates really hit a pretty high point. And then they continued to climb. And in the early 80s, interest rates were in the high teens. And so it wasn't uncommon somebody buy a house at an 18% interest rate. We didn't see interest rates drop again until 1993. So you think about how much appreciation did people lose out on if they said 1971, I'm going to wait until prices come down or interest rates come down. Interest rates, they waited from 1971 to 1993 before they came down. And so if you sat on the sidelines, you lost out on a ton of wealth. If interest rates go down, if you buy something today and a year from now, interest rates drop 2%, hallelujah. Because if it makes sense today, how much better does it make sense 2 years from now when you refinance at 2% lower? So you just make sure it's a good investment, because there's opportunities at all interest rates. I've got a good friend who started a home building company that ended up building about 5,000 homes a year. And he started it in the early 80s when interest rates were in the high teens and everybody was crashing. So there's always an opportunity.
Yeah, I love that. It's just, and there's obviously, there's a fear, right? There's a lot of noise out there. And I think for me, it's always, okay, minimizing your consumer debt so that you can make sure you're in a good position. But I like what you're saying about also finding a way where you can have another person like somebody living there or a duplex. So how do you recommend people find the right deal for them? Or what would you say is some good advice on?
Depends on the market you're in. Each market is unique across the United States. And so you've got to really watch your market, and you just got to be diligent and patient. If you're in a hurry, that's when you're going to make a bad decision. We buy a lot of real estate. We're constantly buying new real estate. And one of the exercises we go through is, in our case, we have a team. If you're buying it yourself, you're going to do this by yourself. But we have a team, and they run the pro forma and they say, okay, how does this thing perform? What are we going to do with it in the end? And once they have the proposal, I'll go in the room off and I'll say, okay, Tanya, you're going to argue for. Mike, you're going to argue against. And then, Tanya, you got to tell me why we should buy this. Mike, you got to tell me why we shouldn't, why it's a bad deal. And then we'll switch. And ultimately, if you can't see the risks, you don't see why you shouldn't buy it, that's for sure a deal you run from, because there's a risk in every deal. And so we look at it and say, what's the upside? What's the downside? Can I live with the downside? If the answer is yes, then let's go do the deal. But there's always going to be a downside. And if you can't live with that downside, you don't do it. So it comes down to run that exercise and be patient. If you've got a realtor, they can set up alerts in every market in the United States. They can set up alerts. Here's the boundaries I'm looking for. And you just get an email. And when you see one, you act on it fast. There's Zillow. Zillow's a little less accurate. Realtor.com's a little less accurate. But you have to be patient. But eventually something will pop up that meets your needs, your skill set, and go quick.
So Dale,
Yeah.
I really like that. The fact that you have people argue for the deal and have somebody argue against the deal, and the pros and the cons, and then have them switch and everything too. So it gives you a unique perspective from two different people, and when they're arguing both sides of it. And yeah, that makes me curious about some of the deals that you're finding. Yeah,
I was going to say about that too. I think that's a good exercise to do on the majority of things in life, not just obviously buying home is one of the biggest purchases you'll ever make. Just how you play the pros and cons of things and really thinking something through, but also then making a decision, right? Like using it to make a decision, yes or no. Not a lot of people have hard times with making a decision. Is that the right decision? But yeah, I love that framework.
Yeah, it's a good way it's a good screening process. So Dale, when it comes to these deals that you find, right, or your team finds, right, and then you guys have these meetings where you establish whether or not it's a deal you should take that risk on. I wanted to ask you where your focus is. Like, what kind of real estate focus do you have? Is it single families? Is it small multifamily? Is it large multifamily? Where's your focus right now?
Right now, it's mostly single family, and that ebbs and flows depending on the market. The office market is a tough market right now that everybody's a little unsure of. The multifamily markets, everybody's a little unsure of. Housing, there's a lot less uncertainty. There's a huge need for houses. What's an interesting dynamic with houses right now is because interest rates have gone up so much, there's a lot less existing inventory to people to choose from. If I've got a house and it's like, all right, I'm ready to get a larger house because we had a baby, I got married, I want a home office, whatever it may be. That's pretty tough to say, I'm going to go buy a house that's 20% more money, but my interest rate is going from plus or minus 3% now to plus or minus 7%. And so a lot of people are just staying put. It just doesn't make sense. There certainly people have to move for various life circumstances, but the majority of people are staying put. And so there's just not as many options to be able to buy. And Mike, I apologize. I don't even remember what your question was. I just started rambling.
Oh, no, yeah. I was just asking about where your focus was, whether it was single family,
Oh
multifamily.
yeah. Sorry. Yeah.
So,
So we're really focused on single family because there is such a need. We see as interest rates go up, what'll happen is we'll see the interest rates climb and then they'll stabilize and the market kind of paralyzes for a little bit. Okay, are they going to continue to go up? Are they going to go down? Everybody sits and does nothing for a couple of months. And so the sales drop. And then if they continue to stay stabilized, people come back to the market and start buying again. And then if they jump up, which what we've been seeing happen the last couple of years, they jump up again, they all paralyze, they freeze, and then they come back. If they drop again, they come back in. And so we're seeing it's very cyclical, up and down on the single family. Now, with that being said, that is right now in real estate one of the best asset classes because we're short millions and millions of homes nationwide. And apartments are really strong in that there's a need for housing. On the flip side, the challenge with apartments is a lot of people bought them with a balloon loan. So a balloon loan is 5 years from now, 3 years from now, I've got to pay my loan off. So people that bought their apartments in 2018, 19, we're now seeing those balloons come due. Well, they ran it and said, oh, I can make a lot of money based on this 3.5% interest rate. Now they're trying to refinance it at 7 to 8% interest rate, and the thing doesn't make money anymore. And so that's where we're seeing the struggle in the multifamily is making sense of the deals, even though there's still a need for housing. So we really, the single family right now, the for sale housing is the strong play for us.
yeah, so I've seen that a lot in the multifamily side, that you're seeing more like capital calls and things like that happens. That's definitely interesting. But there was something that you said that really stuck out to me when it comes to why there's such a low inventory of single family homes. And I think of myself as an example, right? My home in Hawaii, I have a 2.25% interest rate on it. You're going to have a hard time getting me out of this house, right? Especially that
Yeah.
interest rate, unless you offer me like a buku amount of money so I can go buy my next place cash, right? Because when I first bought this place, I had a 4.625 interest rate, which, man, people would kill for that today.
Yeah.
When I had that interest rate, I was like, man, this is tough. And when I was able to get it down to the 2.25, I was like, I ain't going nowhere. So I think that's important because where my mentality is with that's a lot of people are thinking that way right now. Hey, I've got this low interest rate. It's crazy for me to try to move anywhere else and sell this place. I'm not going anywhere. So that's a great point when it comes to our inventories. I want to ask you, like, how do you as an investor overcome the limited inventory that we have with single family homes being so lucrative right now because of that limited inventory? How do you go about finding these actual deals?
Because we're focused mostly on single family, we as a company are focused mostly on doing land development, land plays, and then building them out. So we'll go in and buy a piece of land. We'll turn it into, we've got one project that it was raw ground. We're now putting in 105 lots this summer, and then we'll build the houses and sell those houses. We do keep some of the houses. We're seeing in the markets we're in right now that we can keep some of the houses as rentals, that there still is a need, and at current interest rates that we can make those make sense. But the primary focus is for sale housing. And so we're going in and we do the entire development, the entitlements, put the roads in, and then build those houses. And that's right now where we're seeing the best opportunities.
Yeah, I've been seeing that. Obviously, where I live in Northern California, there's not as much development, except in Reno, next door to us, is blowing up. So is Arizona, where my mom and sister live. Just crazy amount of new houses. And it's almost like is it like this where you're at now? I want to get into like your market and why there's an advantage there. But so it almost makes more sense to buy a brand new house than it does a little bit older house that's almost the same price. Are you finding that's a similar thing that's happening where you guys are?
Yeah, the advantage of the new house is it doesn't, the furnace has got a warranty on it. The roof is new, it's got a warranty on it. The other is the existing houses, there's just not that many of them out there. And so your options are really limited. And that's partly why new construction is doing so is we're selling houses, but we're really not competing with the existing inventory. You're seeing where you're at, the Reno Carson City area is taking off because you got a lot of people that are saying, I could just move over the border just a little bit and I've got no income taxes in Nevada. And California, they had a proposition back in the 70s that froze people's properties taxes. So when you buy it, it freezes in time and it never goes up again. And so that keeps people in place quite often in California. So they say, well, if I'm got to buy something new, let's just go over the border and we'll buy, new construction. And therefore you've got Reno and Carson City are just taking off like a rocket because of that. And they have been for quite a few years. And in those markets, they've got limited inventory as well. They're just not big markets. And so it is market unique across the nation, but for the most part, interest rates are not unique across the nation. So a lot of people are staying put. Just like Mike says, why would you ever leave?
Yeah, absolutely. Dale, with that said, what market do you invest in? Like, where are you doing these developments at?
We're predominantly in the Minnesota market is where we are consistently. We do some things in other markets, but our main office is in Minnesota. And so that's where most of our focus is predominantly. One of the great things about the Minnesota market is there's a couple of things going for it. It's a cold market. And
Literally.
Tanya says, what's that?
Literally.
Literally.
That's exactly. It's freezing cold. And I convinced Tanya, hey, come work with me. Let's come here. You work here for a period of time. And then if something happens and you need a new job, most people will leave this market. They aren't going to stay in the market because if they don't have a connection, why would I stay here versus I can go to a place like Hawaii or Florida? And so the unemployment rate is consistently very low in Minnesota. The positive is we have a huge variety of Fortune 500 companies here. You've got the retail where you've got Target and Best Buy are headquartered here. The banking, we've got US Bank is headquartered here. You've got ag, you got General Mills is here, Cargill is here. You've got medical, you've got Medtronic and Guidant are both based here. And so you can have one sector crash and this market hardly even notices. And so that's one of the reasons we really like this market is unlike some of the Sun Belt or the California markets where they are so cyclical, the highs are really high, but the lows are equally low.
No, that's a really good point. A lot of people don't think about Minneapolis as being that hub for so many industries and so many businesses. And that's really cool that you got in there. But what are the margins like for you guys when you're building something like this? Run us through the common scenarios that you're seeing currently and what those margins for you look like when you're running the numbers.
Yeah. On the new construction right now, we've got 2 investment opportunities that are open to the public as an example. And those are running, one of them's at a 17.8% IRR. It's a 2-year deal where we're going in and building it and seeing a 17.8 return. The other one, I believe we're just under 20 IRR, but that's a 4-year investment. One of them, the money stays a little longer. Now, if people don't understand IRR is a little complicated, and that's the industry standard. I don't love IRR. The reason being is it can be manipulated so easily. I could take those numbers and with a few tweaks, I can make it look artificially high. For me, the much better barometer is the return on the investment. So 17.8 IRR, that project is a 34% return on investment over a 2-year period. So if you look at it that way, you say, oh, okay, now I'm a 16% return on my investment. And that's what I like. We do the IRR just because that's what the industry expects you to say. but it's a tough one. And if you don't really understand IRR, it's easy to get fooled.
Yeah, it's funny that you mentioned that too, because I invest in multifamily real estate as a passive investor, as a LP, and that a lot when you get these presentations and you're looking at the projects that they're working on and what the IRR is going to be. And so I like to get into the weeds. I don't just look at the spreadsheets or the slides that get sent out. I like to look at the spreadsheets. I look to look at their numbers and how they're getting this IRR. And then you can see if you just fudge it a little bit, what kind of big difference that can make. If your expenses just got lowered a little bit and your average rent and vacancy, if your vacancy is lowered a little bit and your average rent went up a little bit, man, these numbers just change in a huge way. So I like to go with folks that are very conservative with their numbers. I like when people under promise and over deliver. I like where your thought process is with that, right? Because RRs are great, but what's reality going to look like in the end, right? What actual return am I getting as an investor in the end? I'm working with somebody right now doing some projects on the Big Island developments over there. Same thing, 2-year projects. And those, honestly, they're doing much better than somebody that's buying a place, renovating it, and then renting it out. It's just, man, that market is tough. So the developments are definitely making it happen right now. So
Yeah, for the listeners, I think, Mike, you make a really good point, because if you look at it conversely, it's so easy to tweak the IRR.
yeah.
And there's a lot of guys out there that all of a sudden you're like, oh, 24, 25% IRR. And you look at it and they tweak the numbers the opposite direction and they juiced it a little bit stronger. And all of a sudden it's 24 really realistic, because your point, but if costs go up just a little bit or sales price goes down just a little bit, your rents go down just a little bit, all of a sudden you can go from a 24 to a 10 in a blink of an eye. And so you're right. To all the listeners, you really need to dig into the numbers and understand, how did they come up with those numbers? Because IRRs can be so misleading, I think.
Yeah, your own due diligence is super important. Don't just
Yes.
trust what's on a piece of paper.
Yes.
Yeah, I think that's great advice across the board. I always advise people know how are like overly educated on everything. And how can people, you mentioned this a second ago, but you said if someone's investing with us, like how can people go about doing that, or how can people find you guys, and what does that look like? Is there an amount of money that they have to invest with you, or how do you work that process?
Yeah, so right now we have 2 new home subdivisions, and they're both projects. One is a project we're in the second phase. The nice thing about our numbers are it's based on a proven phase 1 already. And then we've another one in a town that we're just a quarter mile up the road from a project we just finished that we're doing another. And so we've got centracapitalpartners.com is our website, and they can get all of the information about the projects, the past history of our company. And so we do have a minimum $100,000 investment. And so somebody goes in, they can learn all about it. They invest. If they do the one that's a 2-year, they're going to see all their returns plus their principal in 2 years. One of the things we're really excited about, we just don't know, by the time this goes public, we will have already released the press release, but we've either released the press release just recently or we're about to, that we teamed up with Equity Trust. And Equity Trust is an IRA company, a retirement facilitator. And the industry will say self-directed. There is no such thing as a self-directed IRA. The IRAs are just alternative investments. Typically, people invest their IRAs or 401ks in stocks, bonds, more of the traditional. Equity Trust, somebody can transfer their money. I just actually personally did this with my wife's and my IRAs. We just transferred once we teamed up. It took me 13 minutes to do the entire application. Now, the average person will take a little longer than that because I was familiar with the process, but we transferred it. And now I can invest my IRA funds. So people can invest their IRA funds in these. And now you're making this money and you're not paying taxes on it until your retirement when you pull it out, or you're a Roth and you can compound it. We ran the numbers. If you're getting a 17.8 IRR and you have $100,000 in investment, you're well over $1 million in a matter of, I think it was 12 years, which is just incredible. And so we're pretty excited that we have that now. Yeah.
Yeah, that's really cool. Wow. That's a really cool option for people, because I know a lot of people, even with their investments, are like, what is this invested in? Or they're like cautious of the stock market for whatever reason. So this is a good like alternative.
I'm a big believer invest in what you know. I've invested a lot of money and I've learned this principle over and over. I'm not a very quick learner, evidently, when it comes to stock market. I have lost way more money in the stock market than I have ever made. It's like going to a casino for me. No matter what I do, I lose in the stock market. And I'm liquid more than I'm invested because I believe in this stock. And then all of a sudden I've lost a bunch of money. I just have no clue what I'm doing when it comes to the stock market because I don't take the time and spend. And that's why we see a lot of these money markets that are out there is because of guys like me. But then you get frustrated and say, how in the world am I supposed to get ahead when inflation's at 5.21% and I'm getting 6% return on my investment? That's terrible.
Yeah, it's funny that you mentioned that, Dale, because in the stock market, I prefer to stick with index funds and ETFs just to be on the safer side because every time I do individual stocks, man, I don't make good moves on my own. Like I literally, I found a company that I believed in, right? So I'll just give this as an example, like Lucid, right? Electric cars, their cars look so cool. I was like, oh my God, this thing's going to take off. I invested in it when it was $23 a share. It is worth $2 and change right now.
Oh, Mike,
Needless
I
to
feel so much
say,
better about
it was
myself because I bought a bunch of Tesla stock.
I had an 80% loss, or 86% or something like that. It was gross. But guess what?
You make me
I'm
feel
still
better about
buying it to
myself.
dollar cost average to get my dollar cost average down,
Yeah.
just so I don't feel as bad. But yeah, so that's a great point, right? Because a lot of times folks are investing their IRAs and they're entrusting it to a financial manager that's going to manage it in the accounts that you want them to. But this gives you a little bit more flexibility and a little bit more control of what you're doing with your retirement account. So I think that's fantastic.
It's my dad heard about this and he's son, I want to invest. I'm like, I don't know. You keep the family distance. Well, let me take a look at your IRA. So I looked at his IRA. He doesn't have a ton of money in there, but I looked at it and when it's all said and done, he's getting like a 3% return by the time you figure out all the fees of the fund manager and they're investing it in a conservative. And I'm like, Dad, you're actually losing money. If you factor inflation, you're getting a negative return on your money. This is terrible. So I conceded and he's now invested all of his IRA in us.
Oh, that's awesome.
But
Awesome.
yeah, the fees just eat you alive if you're not careful.
Yeah. All right. Hey, Tanya, I'll let you hit him with one more question and then we'll go ahead and transition this to the final round.
Yeah, I think that I'm trying to think of if I didn't hit on anything that I wanted to ask, but no, I think you gave a good overview and I just giving people other options and opportunities to see what's possible for them. So should we go into the final round?
Yeah. All right. Hey, let's do it. Dale. All right. So the final round, we're going to ask you the same 4 questions we ask everybody that comes on the show. It puts you on the spot a little bit, but it gives us a good idea of where your mentality is when it comes to certain things. So if you're ready to go, we'll get this part of the show going.
Let's do it.
All right, Dale. So the very first question of the final round is, and I'm sure that there's plenty, but we want to know what is your biggest mistake that you've ever made when it comes to your finance or business life?
Oh, the biggest mistake. I owned the number one Radio Shack franchise in the world. And it was growing. And so we just kept investing. We bought all of our inventory in the summer and you make all your money Christmas season. And so we bought 20% more inventory and 9/11 happened. And that next week we had one buyer came into all 3 stores in that week and they're called rabbit ears that go on TVs to be able to get reception, to be able to watch the news. They wanted rabbit ears on their TV at their office. The day after Christmas, we had over 90% of our inventory sitting on the floors. And ultimately, I ended up having to file bankruptcy. Now, on one hand, you say, okay, that was a huge mistake. And if I would have managed our finances better, we would have been able to forecast that and navigate it a little bit better. But on the other hand, I say, I don't know because we're really good at watching our budgets, reading our financial statements. Accounting is the language of business. So if you want to be in business, you better understand the language. And so it was a really great learning experience for me because we're really good at managing our finances now as a result of that experience. But that was a disaster. And had I known what I know now, we would have been able to avoid much of the losses.
Wow. Yeah, that sounds like pretty intense. And obviously there's some things out of your control there with what was going on in the world. But yeah, that's great. And a side note, one of my first boyfriends worked at Radio Shack. So I spent a lot of time in hanging out in there.
I
I loved
used to
like
be
the
an avid customer of Radio
yeah,
Shack for
the
sure.
living rooms. Like I love just like going to hang out and like sing with the sound system.
Yeah.
You don't have that experience anymore for the most part. Okay, next question. What is something you learned that you wish you knew when you first started out?
I think it's the habit of learning. It's constantly learning. People will ask me, what's your favorite book? Well, that depends on what's going on in my life because different books will speak to me at different times. What's your favorite podcast? Well, what's going on in my life because different podcasts will speak to me differently
Well,
based on
don't
my
don't answer
needs.
those yet. That's one of the questions.
Oh, okay. But I think I wished I would have adopted the habit of learning much earlier. By the time I was 20, I don't know that I had read two books in my life. I don't know that I wasn't hungry for and thirsting for knowledge. And that's the biggest thing I would have wished I would have done earlier and different was to really strive to learn as much as I can, educate yourself in any way you can, whether that's formal education in school or whether it's podcasts, whether it's books, whatever it may be. Just keep learning. And I wish I would have done that earlier.
Yeah, that's a fair point. That's a fair point. I like to think most entrepreneurs have themselves become lifelong learners, right? Because you're either going to learn it by getting the education yourself, or you're going to learn it the hard way and pay for it the hard way by learning from expensive lessons
Yeah, you're going to get an
from the
education. It's
mistakes that
just
you
how
make.
much is it going to cost you?
Exactly, exactly. And you might still pay for a master's level education, whether you wanted to or not.
Yeah.
But all right, Dale, the next question, you can see these all kind of tie into each other, except for the final question. But so this next one is, do you have any tips or tricks that you would recommend to someone that is just getting started out as a real estate investor today?
It actually goes back to the answer of my previous one. I love to ask young people, I say, I want you to picture where are you going to be 20 years from now? Visualize your life 20 years from now. Where do you want to be? What does your life look like? What do your relationships look like? What do your finances look like? Your career look like? Okay, once you have it, say, I believe we become the average of our peer group. So now I want you to look at it and say, how many people do you know that you would consider a peer that you routinely associate with that are where you want to be? And if they ever give me an answer of one or more, I say, well, your dreams aren't big enough. But usually they'll say, I have zero. Okay, so what do you do about that? If your peer group aren't where you want to be, how do you grow? How do you associate with people that are encouraging you and inspiring you and giving you ideas and lifting you up? How do you do that? That's really tough because you can't all of a sudden say, I'm going to go find a new peer group because the people are where you want to be are 20 years older and they're probably not going to be hanging out with you on Friday night. And I think the best way to do it is through books and through podcasts, through seminars. I love biographies and hearing what other people have done, whether it's their failures or their successes, because I can live vicariously through them. And that then suddenly becomes my peer group. And you start small. You can go to the library and get books for free. You can go and listen to these podcasts for free. And then eventually you can pay to have peer groups. I belong to a lot of different associations where I have those peer groups now, but there was a lot of years I didn't have the peer group. And that's really what's important because most of us are surrounded by people that are saying, oh, that's a dumb idea, or you can't do that, or why would you do that? And they're trying to pull us down. And you're never going to get anywhere as long as you're getting pulled down. So you've got to figure out how do I have that influence of that positive mindset that I can do it. It's possible.
That's huge. I think networking is a big part of that. Like you said, you like to go to seminars. I love going to real estate conferences and meetups. My goal is always to meet two or three people that I want to really keep in touch with after the conference. Maybe no more than five, but really focus on getting connected with them and picking their brain and just having those conversations. And I'm a member of mastermind groups as well that I pay to be a part of because I feel like that because I pay for it, I hold myself accountable more to the
Yeah.
people that I work with in that
Yeah.
mastermind group. So I feel like I'm really picking up what you're putting down there. So I really like that answer. So thank you for that.
Yeah. I do the same. And now I look at it and go, so now I'm buying my friends. I'm
Yeah.
not sure.
I wouldn't say necessarily buying your friends. You make friends in a program that you pay for to hold yourself accountable.
Yeah.
I absolutely
Yeah.
agree. I belong to several groups. I was just
Yeah.
teasing. I just tease myself sometimes and say, so am I buying my friends?
If you
Yeah,
think about it, you always are anyway, right? If you're going out to the movies or if you're going out to something, you're going out to dinner, you're paying anyway, right?
Yeah.
So,
I obviously love that. Being a coach, I think that's one of the number one things that like people come to the coach for the accountability and kind of to be
yeah.
pushed and to grow in that way because they aren't surrounded by a lot of people. And for me, I've been doing that assessment in the last year, especially like the people I've been hanging out with in the last year are just like they are a little bit older, but they are just like, wow, they're really making me think differently and have just amazing things going on. But also like we can connect and relate to each other and we enjoy the same activities, snowboarding, going on the boat, like things like that. So you have those commonalities with people, but like just learning and growing, I think that's obviously one of the best things you can do, no matter who you are.
Tanya, I think you
Love
make
it.
a really an important point there. I talked about you start out, you have no money. When you start out, you have nothing. And so you're going to the library, you're going to podcasts, those kinds of things. But a coach is a great example of a coach can be really invaluable. I've had coaches and coaches can be invaluable in that they're going to inspire you. They're going to help you see what you don't see. And they're going to help inspire you of see what is possible to be able to grow. And in many ways, you now have a coach that is that peer that's saying, you can do this, but also helping you see those blind spots that you might not see. And I think coaches really are invaluable if you've got one that you really can connect with.
Yeah, especially if you can't change your environment, because I think the other
Yes.
best thing you could do is change where you live, change your environment. A lot of people maybe can't do that or whatever it is. So yeah, I think that's an easier way. But for me, I've always put myself in uncomfortable. Like I live in an environment where I see the crazy amounts of wealth around me all the time. And obviously I had to assess who I was. Am I with like nothing wrong? Because I have a lot of people in the restaurant industry, but am I hanging out with like just people that aren't really motivated and aren't trying to do something more with their lives? Or am I surrounding myself with people who are always pushing themselves in some way or are goal oriented,
It's,
growth
it's a
mindset?
delicate balance. It's a delicate balance.
Yeah. Yeah. And then you started to touch on this last question, but do you have any favorite business investing or real estate related books right now? Like what are you listening to and what's
I
Or
I, I
podcasts.
I listen to a lot of podcasts. Your podcast is great. I've listened to many of them, but get caught up. What do you guys have? 270s, 280
250. Yeah,
episodes?
we just 251's coming out tomorrow. So,
That's yeah. There's just a wealth of information. This podcast is a great example. I've listened to many of your episodes and they're fantastic. So there's a lot of podcasts out there. I listen to a ton of podcasts. I read a lot. I read 50 to 60 books a year. And I use that term loosely because probably 70% of my books I'm actually listening to on audio through my phone. A couple of books for me just recently from a business standpoint that I've really enjoyed is Ben Hardy, co-wrote with Dan Sullivan, Who Not How, 10X is easier than 2X, and The Gap and the Gain. There's a ton of books that I could speak to that I love. Those are just ones that I've read recently that really spoke to me that you can look at. It's easier to grow 10 times than it is 2 times. If you read the book, it teaches the principles. And quite often when we're looking at trying to accomplish something, we're focused on the logistics. How am I going to get this done? Versus really if we could focus on the who. I'm not an expert at everything, but let's make sure I surround myself with experts in that and have the right who around me. So those are ones that recently have spoken to me, but I could talk for hours about books. I love books.
well, yeah, you said you read like 50 a year, which is wow. That is phenomenal, man. Especially from somebody when you said in your 20s, you maybe read 2 books.
I think
Yeah.
he's
It's
making
like
up for all that last
yeah,
time. Now he's
it's the
like,
two they made you read in school.
Let's actually, I read Where the Red Fern Grows and James and the Giant Peach. Those are the two books I can remember that I ever read before I was 20.
Awesome.
And they
Awesome.
didn't teach me a lot about business. Oh,
no.
you know what? I have to take that back. I did read a book. I forgot How to Raise Pigs. I read that in the third grade.
Oh,
Huh.
I
that
started
you
raising pigs in the third grade to sell.
That might be very relevant to what you do now
yeah,
with where you
exactly.
currently live.
Yeah.
So,
Yeah.
but now
It
with
all
cows.
comes full circle somehow.
Yeah.
Yep. Yep.
Awesome. Okay. All right, Dale, that is it for the final round. So you survived. So really great job there. And really some of those answers that you gave us were just absolutely golden nuggets that I think provide a lot of value to our listeners. So I really appreciate that. With that being said, I'm going to ask you one more question. And this is probably the most important question I'm going to ask you throughout this entire interview. And that is, and you talked about your website already, but still I'd like to mention it again. But where can people find more information about you? Can you share your website with us? any social media profiles, anything that we could follow to learn more about you and your team?
Yeah, thanks for asking. Specifically about me, if you go to LinkedIn and look up Dale R. Wills, there's a lot of information about my background. Opportunities to invest in with us is centracapitalpartners.com. And that shows whatever investments we have at the time and a lot of information on what the investments are like and how you can invest, whether you're looking to just invest cash or you're looking to invest in retirement funds. You can go to centracapitalpartners.com or Dale R. Wills at LinkedIn are two great ones. I'm not very good at all of the other social media, so we just focus on one or two.
Right on.
Yeah, thanks
Well-
for sharing. I'm excited to check that out too. And you guys definitely go check out Dale and all that they're up to, especially if you're interested in investment opportunities.
Awesome. So again, this was fantastic. Great interview. Thank you so much. Really appreciate you coming on the show to join us today and just share just so much valuable information, especially in this current real estate market, right? Things are crazy out there and people need that to have that good advice to rely on and keep learning, right? As we said before, we're lifetime learners. Episodes like this, man, this is great because you did provide a lot of value. So thank you.
Yeah,
Oh, thanks. I appreciate you guys having me.
Awesome. Hey, also to all of our listeners out there, the first thing I want to say is all those links and everything we talked about before, if you are driving right now, please do not go try to click on those, but they will be in the show notes for you. So go check them out. But I want to thank all of you so much for listening to this podcast and joining me, Tanya, and our special guest, Dale Wills, on the Average Joe Finances podcast.
For sure. And don't forget to leave us a 5-star review if you found this valuable today and let us know what you liked about the episode.
All right. Hey, and with that being said, aloha from Hawaii
And Lake Tahoe.
and have a great rest of your day. Thank you for making it to the end of this episode. Greatly appreciate you being here with me today on the Average Joe Finances podcast. If you haven't done so yet, make this the episode that you go leave us a 5-star rating or subscribe to our YouTube channel. The Average Joe Finances podcast is for informational and entertainment purposes only. Have an outstanding day.